You look at the world today, and you see a lot of people who are absolutely miserable because they have convinced themselves that they need $10 million to be free, and until they get it, they are permitted to act like desperate, frantic fools. It is totally assonant. The first 100,000 is a bitch, as I have said before, but the first 300,000 is the fortress. If you cannot be happy with 300,000 in the bank and a modest life, you will not be happy with 300 million because you are a person who has not learned how to subtract. You only know how to add, and adding to a life filled with misery and stupidity just gives you more misery and stupidity. I look at the young people today, the finfluencers, or whatever you call these charlatans peddling courses on the internet, and they are selling you a vision of wealth that is simply a Lollapalooza of envy. In the Daily Journal annual meeting of 2019, I told you all that the world is not driven by greed, it is driven by envy. You don't want 300,000. You want what your idiot brother-in-law has plus 10%. That is a recipe for a life of total wretchedness. You are chasing a mirage of financial freedom. That requires a private jet, when true freedom is simply the ability to do what you are supposed to do without answering to a moron. If you have 300 and you are disciplined, you have the go-to-hell money. You can walk away, but you won't, because you are too busy buying watches. You can't afford to impress people who don't care if you die tomorrow. The problem with the modern generation is that they treat the stock market like a casino where the dealer is supposed to hand them money just for showing up. It is pathetic. Look at the way the great businesses were built. Look at the early days of Berkshire Hathaway, or the way John D. Rockefeller operated Standard Oil. They didn't wake up every morning checking the ticker price on their phones, sweating over a 2% drop. They understood the power of compounding, and more importantly, they understood the power of sitting on their ass. There is a huge advantage to just sitting there and doing nothing. In the 2002 Wesco annual report, I wrote about the folly of eBay-TDA and this modern obsession with pretending that depreciation isn't an expense. It is the same mindset today. People pretend that risk isn't real, that leverage is free, and that trees grow to the sky. You have people buying meme coins and digital pictures of monkeys calling it investing. It is rat poison. Actually, it is rat poison squared. The old world builders understood that wealth is the byproduct of rational temperament, not a lottery ticket. They built fortresses of capital that could withstand wars, depressions, and inflation. You are trying to build a house of cards in a hurricane because you lack the patience to lay the bricks one by one. You want the bonanza without the discipline, and nature does not work that way. Nature is brutal to fools. I am not your advisor, but if I were, I would tell you to consider taking that first 300,000 and then locking it away in something so boring that it makes you want to cry, and then forgetting you own it for 30 years. That is how you get rich. But you won't do it. You will try to be smart, and that brings us to the most important mental model you will ever learn, a concept I stole from the great German mathematician Karl Jacobi invert, always invert. Most of you are asking, how do I turn this 300,000 into 30 million by next Tuesday? That is a forward-thinking question. And it is a stupid question because it has infinite wrong answers. The better question, the inverted question, is what could I do to ensure that this 300,000 disappears and leaves me destitute? If you figure out what destroys wealth and you avoid those things, you will eventually become rich by accident. It is hard to be a brilliant investor. It is much easier to avoid being a total idiot. If you can just avoid the standard follies that ruin most people, you will look like a genius in the long run. Let's look at what destroys that 300,000 nest egg. It isn't a market crash. The market will crash. That is what it does. If you can't handle a 50% decline in your quoted asset prices without panicking, you deserve the mediocre result you are going to get. No, what destroys the money is a you. It is your temperament. It is your desire to get rich quick. In the 1995 speech at Harvard regarding the psychology of human misjudgment, I laid out the biases that fry the human brain. You are fighting millions of years of evolution that scream at you to run when the herd runs and buy when the herd eats. To secure that 300,000, you have to invert the standard behavior. You have to look at what the crowd is doing and feel a deep sense of revulsion. When everyone was buying .com stocks in 1999, or housing in 2007, or SPAs in 2021, they were acting out of social proof and greed. If you had simply inverted, if you had said, "This looks like a mania, I will stand aside," you would have preserved your capital. The ability to do nothing is a superpower. I have a personal story about the cost of stupidity, and I want you to listen because it cost me more money than you will ever see in your lifetime. It was the 1970s. I had the opportunity to buy a significant stake in a company called Belridge Oil. It was sitting there, undervalued, a clear bonanza. I knew it was cheap. I knew the management. I knew the assets. But the price rose slightly, just a fraction of a point, and I got stubborn. I wanted it at pay my price. I was trying to pinch pennies on a gold mine. I sat there sucking my thumb, and I didn't pull the trigger. That decision, that specific act of omission, cost me an eventual $5 billion in opportunity cost. $5 billion. Because I was too clever by half. I violated the inversion principle. I should have asked, what is the worst thing that happens if I overpay slightly for a wonderful business? The answer was, I make a little less money. But I asked, how can I get the absolute best deal? And the result was I got nothing. Do not be like me in 1974. Do not let your ego get in the way of the compounding. Now, let's talk about the specific mechanics of avoiding ruin, because that is what 300,000 represents. It is your shield against ruin. If you have this money and you lose it, it is because you made one of the 3 decisions that destroy men. The 3 decisions are: 1, using leverage to buy things you do not understand; 2, trusting people whose incentives are misaligned with yours; and 3, allowing your lifestyle to creep up to match your income. If you avoid leverage, you cannot go to zero. It is mathematically impossible unless you buy something that goes to zero without leverage, which is hard to do if you buy quality. Buffett and I have always said, if you're smart, you don't need leverage, and if you're dumb, you shouldn't use it. In the Berkshire annual meeting of 2010, we discussed how leverage is the only way a smart guy can go broke. You take your 300,000, you borrow another 300,000 on margin because you think you found a sure thing, and suddenly the market dips 20%. You get a margin call. You are wiped out. You are back to zero. You have snatched defeat from the jaws of victory. It is insane. And let's address the lifestyle creep aspect of inversion. You think 300,000 isn't enough because you have been brainwashed by a consumerist culture that needs you to be broke. You look at your neighbor's Tesla and you feel inadequate. This is the deprival superreaction. Tendency I spoke about in 95. You feel like you are losing something you never had. If you invert this, you realize that the less you need, the richer you are. A man with 300,000 earning 5% who spends 10,000 a year is infinitely wealthier than the man with 5 million earning 5% who spends 500,000 a year. The second man is a slave to his overhead. The first man is free. It is simple arithmetic, but you people treat it like it is quantum physics because you cannot control your urges. You are like a heroin addict looking for the next fix of validation. The modern financial system is designed to mine your wealth through fees and complexity. They want you to trade. They want you to churn. In the 2004 annual meeting, I called the mutual fund industry a scandal. They take your money, charge you 2% to underperform the index, and then tell you it's for your own good. If you invert the process, you ask, how do I pay the least amount of fees to the fewest amount of people? The answer is usually to buy a broad index or a few wonderful companies and then go into a coma. But you can't do that. You have to tinker. You have to optimize. Optimization is the enemy of the good. You are trying to use a computer to solve a problem that requires a sledgehammer. The sledgehammer is spend less than you earn, invest the difference, and shut up. You need to understand that 300 $100 is the critical mass. In nuclear physics, you need a certain amount of fissile material to sustain a reaction. In wealth, that number is roughly 300,000. Once you have that, the interest starts to do the heavy lifting. 0.5 billion. If you can get to that number without succumbing to the folly of the crowd, the momentum shifts. But getting there requires a level of character that most of you simply do not possess. You are too soft. You want the government to save you, or you want a crypto, coin to moon. You don't want to suffer the indignity of driving a used car for 5 years. You don't want to look poor to get rich. I have said it 1,000 times. It is not necessary to be brilliant, only to be a little more wise than the other guys, on average for a long, long time. But wisdom is hard. Stupidity is easy. Stupidity is fun. Stupidity gets you likes on social media. Wisdom gets you 300 Zerosen and a quiet life. I want you to think about the concept of standard doctrine. In the military or in aviation, there are checklists. You don't take off in a 747 by feeling it out. You follow the checklist. In investing, the checklist is the inversion of stupidity. Checklist item 1, is this a Ponzi scheme? Checklist item 2, am I borrowing money I can't pay back? Checklist item 3, am I buying this because I did the work, because a guy on TV shouted about it? If you fail any of these, you don't act. In the 2008 Wesco meeting, I talked about how we just throw things in the too hard pile. If I don't understand it, it goes in the too hard pile. 99% of the opportunities you see are in the too hard pile. But you, with your arrogance, you think you can understand everything. You think you can analyze a biotech stock on Monday and a copper mine on Tuesday. It is delusion. You are playing a game you cannot win against people who have better information than you. The only way to win is to not play their game. Play your game, the game of accumulation and avoidance. Ultimately, the reason 300 Zalazin is enough is because it buys you the ability to wait. The most powerful force in investing is not compound interest, it is patience. But patience is impossible if you are desperate. If you have 300 Zalazin, you are not desperate. You can wait for the fat pitch. In the 2003 AGM, I used the baseball analogy. You don't have to swing at everything. You can stand at the plate with the bat on your shoulder for years, waiting for the perfect setup. The crowd will boo you. They will call you boring. They will say you are missing out on the new paradigm. Let them scream. Let them go broke. When the dust settles and the tide goes out, we will see who is swimming naked. And I promise you, it will be the people who mock the boring path. So, invert your thinking. Stop trying to win big. Start trying not to lose. Stop trying to be famous. Start trying to be free. And for the love of God, stop listening to people who are selling you maps to a gold mine they haven't found themselves. Most people treat time as if it is an infinite resource, a bottomless bucket from which they can draw water forever. This is the most dangerous delusion of the human species. You are a biological organism with an expiration date. Your time is a decaying asset. Every single day you wake up, the value of your remaining human capital, the amount of money you can earn with your labor, depreciates while the necessity of your financial capital appreciates. It is a crossing of the curves. If you are 30 years old and you are wasting your time on nonsense, you are burning the most potent fuel you have. The mathematics of compounding are mercilessly attached to the timeline. $1 invested at 20 is worth infinitely more than $1 invested at 50. This is why, or $300 is the magic number. It is the bridge between your decaying labor and your compounding capital. If you get to $300 early, you have bought yourself the luxury of time. If you get there late, you are simply paying for your own funeral. You need to understand that every time you buy a stupid piece of consumer garbage, you are not just spending money, you are burning the time it took to earn that money, and you are killing the future compound interest that money could have earned. You are committing double homicide on your own freedom. I look at the way people manage their lives, and it is a scandal. They act as if they can make up for lost time by taking massive risks later in life. This is the Hail Mary approach to finance, and it almost always ends in tears. You cannot cheat the math. In the 2008 WESCO annual meeting, I explained that if you wait until you are old to get rich, you are fighting against gravity. The heavy lifting has to be done when you have the energy to suffer. The first $300 requires suffering. It requires saying no when everyone else is saying yes. It requires driving a car that embarrasses your children. It requires living in a smaller house than the bank says you can afford. But once you have that capital, the time starts working for you instead of against you. The money works while you sleep. The money works while you are on vacation. The money works while you are reading a book. If you do not reach this point of escape velocity, you will work until the day you die, and you will deserve it because you refuse to do the arithmetic. Now, let us discuss the algebra of opportunity. This is a concept that seems too difficult for the professors at the business schools to understand, probably because they are too busy teaching the efficient market hypothesis, which is bonkers. The algebra of opportunity states that great opportunities are rare. They do not come along every Tuesday. In a lifetime, a wise man might get 10 good insights. 10, that's it. If you get 10, you are lucky. Most people get 0 because they aren't looking, or they are too busy chasing the noise. When you have your 300,000 fortress, you are not looking for average returns. You are looking for the fat pitch. I borrowed this from Ted Williams, the greatest hitter who ever lived. He divided the strike zone into 77 cells, the size of a baseball. He knew that if he swung at a ball in his sweet spot, he would bat 400. If he swung at a ball on the lower corner, he would bat 230. In baseball, if you don't swing at a strike, you are called out. In investing, there are no called strikes. You can stand there at the plate with your bat on your shoulder for 5 years. The market can throw you General Motors at 40E and you can yawn. It can throw you Facebook at 300 and you can ignore it. You can wait for the one moment, the panic, the crash, the mispricing, where the market throws you a slow ball right down the middle, waist high. And when that happens, you don't swing gently. You swing with everything you have. This is where the 300,000 becomes a weapon. If you have no money, you cannot swing. If you have money, but it is tied up in mediocre investments because you couldn't sit still, you cannot swing. Cash is not trash. Cash is an option on the future. It is the ammunition you keep dry until you see the whites of their eyes. In the 2004 Berkshire annual meeting, Warren and I talked about how we sat on billions of dollars for years doing absolutely nothing. People criticized us. They said we had lost our touch. They said we were old men who didn't understand the new economy. Then the crash came, and we were the only ones with the checkbook. That is the discipline you need. You need the temperament to look like an idiot for a long time so you can live like a king forever. But you people, you have the attention span of a gnat. You get $10,000 and you feel this burning itch to put it to work immediately. So you buy something mediocre, you buy an index fund at an all-time high, or you buy a tech stock because your neighbor did. You have filled your portfolio with good enough. And when the great opportunity comes along, you are fully invested in garbage. You have opportunity costed yourself into mediocrity. Opportunity cost is the only filter that matters. Every time you look at an investment, you should not ask, is this good? You should ask, is this better than the best thing I already own? If you own a business that returns 20% on capital with zero risk, why would you ever buy a business that returns 10% with moderate risk? It is irrational. Yet people do it every day for the sake of diversification. Diversification is a protection against ignorance. It is a confession that you do not know what you are doing. If you know what you are doing, if you have done the work, you should own 3 stocks, maybe 4. If you have your 300 zols and you put it into your best idea, and you watch it like a hawk, you will do infinitely better than if you spread it across 50 companies you know nothing about. This is standard doctrine at Berkshire. We concentrate capital. We do not spray and pray. I am not your advisor. But if I were 2.5 billion, I would tell you to consider this when you find that rare opportunity where the odds are heavily in your favor. You must bet big. You must be aggressive. This is the paradox of the sage: extreme patience followed by extreme aggression. You wait for years, like a crocodile in the river. You look like a log. You don't move. You don't eat. And then, when the wildebeest steps into the water, you strike with violence. That is how you turn 300 zalos into a fortune. You don't do it by day trading. You don't do it by scalping pennies. You do it by waiting for the mispricing that is so obvious a blind man could see it, and then betting the farm. But you have to be right. And this brings me to the pain of being wrong and the cost of violating your own principles. I have made mistakes. Warren has made mistakes. But the mistakes that hurt the most are the ones where we forgot who we were. I told you about Belridge Oil earlier, which was a sin of omission, a failure to act. But let me tell you about a sin of commission, a mistake I made recently at the ripe old age of 97, which proves that you are never too old to be a fool if you are not careful. The year was 2021. The subject was Alibaba. I looked at Alibaba and I saw a retailer that was dominating the Chinese market. The math was beautiful. The peak E ratio was low, the cash flow was a bonanza, and the competitive moat looked like the Great Wall of China. I fell in love with the numbers. I thought I had found a fat pitch. It was sitting there cheap while everything in America was expensive. So I bought. And not only did I buy, I did something I have told you people never to do. I used leverage. At the Daily Journal, we borrowed money to buy more Alibaba because the spread between the interest rates and the earnings yield was so attractive. I got greedy. I got arrogant. I thought I knew more than the market. What I failed to factor in, what I willfully ignored, was the political risk. I treated the Chinese government like it was the U.S. government. I forgot that in an authoritarian regime, the rules of capitalism can be rewritten overnight by a single man. Jack Ma disappeared. The regulators cracked down. The moat I thought was made of concrete was actually made of regulatory permission, which was revoked. The stock price was cut in half. The capitalization of the company collapsed. The consequence? I had to sell. I had to take a massive loss. We are talking about a position where the daily journal's portfolio took a hit of roughly 50% on that specific bet. In dollar terms, we lost millions. But the dollar amount is not the tragedy. The tragedy is the opportunity cost. While I was busy being stubborn and wrong about Alibaba, I had millions of dollars tied up in a sinking ship. That capital could have been in Chevron. It could have been in Apple. It could have been in Treasury bills earning 5%. Instead, it was incinerated because I violated my own circle of competence. I stepped outside of what I truly understood, Western capitalism, and gambled on a system I couldn't predict. The lesson from Alibaba is brutal. Intelligence is not enough. You can have an IQ of 180 and still be a disaster if your temperament fails you. I let my bias for value blind me to the reality of the situation. I saw a cheap price and ignored the rat poison label on the bottle. With your $300, you cannot afford an Alibaba. You cannot afford to bet on things that rely on the kindness of strangers or politicians. You need assets that are robust, that can survive a nuclear winter. You need to own things where the math works, even if the world goes crazy. The mistake also highlights the danger of leverage. If I had bought Alibaba with cash, I could have sat on it for 10 years and maybe eventually it would have recovered. But because I used leverage, the clock was ticking. Leverage introduces a time constraint to your thesis. If you are right, but you are right at the wrong time, and you are leveraged, you are dead. If you have 300,000 and you leverage it to 600,000 and the market drops 50%, you have zero. You are out of the game. Never, ever risk being taken out of the game. The first rule of compounding is to never interrupt it unnecessarily. Leverage is the great interrupter. It is the tool of the impatient man, and the impatient man always pays the patient man. You need to view your 300,000 not as a pile of cash to be played with, but as a soldier that you have recruited to fight for your freedom. If you send that soldier into a suicide mission because you want a quick victory, you are a bad general. You need to protect the downside. The upside will take care of itself. In the 2002 annual report, I wrote that we are content to hold cash rather than do something stupid. We pay a price for that holding, the opportunity cost of low returns on cash. But that price is an insurance premium against catastrophe. You must be willing to look foolishly conservative for long stretches of time. If you can internalize the algebra of opportunity, you will realize that you don't need to be smart very often. You just need to be not stupid continuously. If you have 300,000 and you avoid the zeros, and you wait for the fat pitch, and you swing hard when it comes, you will end up with more money than you can spend. But if you try to force the returns, if you try to make the market give you 20% every year like clockwork, you will eventually blow up. The market is not a vending machine. It is a voting machine in the short run and a weighing machine in the long run, as Ben Graham taught us. You are trying to guess the votes. Stop it. Start weighing the assets. So look at your life. Look at your spending. Look at the time you are wasting. Calculate the cost. Every dollar you waste today is $10 you won't have in the future. Every hour you spend watching mindless television is an hour you aren't learning how to identify the fat pitch. You are digging a hole for yourself, and you are smiling while you do it. Stop digging. Invert the behavior. Hoard your capital. Wait for the anomaly. And when the world presents you with a mispriced gamble, where the odds are 10 to 1 in your favor, push the chips into the center of the table. Until then, sit on your hands. It is harder than it looks, which is why most of you will die poor. But for the few of you who can actually discipline your mind, The prize is absolute liberty. The world is full of people who sound like they know what they are talking about. They have the vocabulary, they have the suits, and they have the confident baritone voices. But they are frauds. They are suffering from what I call Schaffer knowledge. There is a story about Max Planck, the great physicist. After he won the Nobel Prize, he went around Germany giving the same lecture on quantum mechanics. Over time, his Schaffer memorized the lecture. One day, the Schaffer said, "Professor Planck, it must be boring to give the same speech every time. I can give it for you in Munich, and you can sit in the audience wearing my Schaffer's cap." Planck agreed. The Schaffer went up on stage and delivered a perfect lecture. He didn't miss a word. But at the end, a physicist in the back stood up and asked a very difficult question. The Schaffer looked at him and said, "I am surprised to hear such an elementary question in an advanced city like Munich. I will let my Schaffer answer it. The point is, there are two types of knowledge: Planck knowledge, which is earned deep and real, and Schaffer knowledge, which is mimicry. The financial world is 99% Schaffers. You turn on the television and you see these talking heads screaming about buy and sell. They are Schaffers. They have memorized the jargon. They talk about resistance levels and moving averages and macroeconomic headwinds. It is total twaddle. It is noise designed to sell advertisements for erectile dysfunction pills. If these people actually knew where the market was going, they would not be sharing that information with you for the price of a cable subscription. They would be on a private island, buying countries. You must learn to ignore them. In the 2007 USC Law School speech, I talked about the importance of knowing the edge of your own competency. If you play games where other people have the aptitudes and you don't, you are going to lose. It is that simple. You have to figure out where your edge is. And for most of you, your edge is not in stock picking. Your edge is in discipline. Your edge is in not listening to the Schaffers. The most dangerous person to your wealth is the man who is articulate but wrong. You are biologically wired to trust confident speakers. This is a Lollapalooza effect of authority bias and social proof. You see a man in a tie on a reputable network and your brain shuts off. You assume he has done the work. He hasn't. He is reading a teleprompter written by a 24-year-old intern. When you have your 300 Zalozen, the sharks will smell the blood in the water. They will come to you with exclusive opportunities and private placements. They will use big words. They will try to make you feel stupid for asking simple questions. Do not be bullied by complexity. Complexity is the tool of the scoundrel. If you cannot understand the business model in 3 sentences, it is a fraud or it is too hard. In either case, the answer is no. You must build a circle of competence. Inside that circle are the things you actually understand. Outside that circle is everything else. It is not important how big the circle is. It is only important that you know where the perimeter is. If you step outside the perimeter, you will get slaughtered. I understand Costco. I understand Coca-Cola. I do not understand how to value a company that has never made a profit and sells digital tokens. So I don't touch it. I don't care if it goes up 1,000%. It is not in my circle. If you chase returns outside your circle, you are gambling, investing. And the house always wins eventually. The 300 Zololoters is your entry fee to the game of life, and you are risking it on a game of chance. It is asinine. To protect this fortress of capital, you must ruthlessly curate your environment. You must structure your life so that failure is difficult. This brings us to the operational framework of the wealthy, the code that keeps the 300,000 safe and growing. It comes down to the 3 decisions that you must make, and you must make them with absolute rigidity first. You must live below your means, creating a permanent gap between what you earn and what you burn, because that gap is the source of all freedom. Second, you must never, under any circumstances, interrupt the compounding process unnecessarily, meaning you do not sell your assets to buy a boat. You do not sell in a panic, and you do not pay taxes you don't have to pay. And third, you must remove toxic people from your life immediately and without remorse, because unreliable, irrational, or envious people are a tax on your mental energy and your wallet that you cannot afford.